So now we've established that setting interest rates is generally a good thing. Aside from creditworthiness, principal, length of term, etc., how are interest rates determined? It turns out that quite often, interest rates are guided by benchmarks. A couple common interest rate benchmarks are the federal funds rate, which is set by the Federal Reserve Bank, and LIBOR, which is set by a group of banks in London. LIBOR, by the way, stands for the London Interbank Offered Rate. In a nutshell, those interest rates determine the rate at which your financial institution, in this case the lender, can borrow money. If the federal funds rate is 1%, by the way, I'm just making that up, that means that your bank can borrow money at that rate. Actually, it's a little bit more complicated than that, but this is a simple way to think about it. So your bank has a source of money that costs them 1%. They then determine how much risk you pose by reviewing your creditworthiness, the term of the loan, how much you're borrowing, etc., and assign a percentage that includes a profit provision. Say that total percentage is 5%. They then add the two rates and charge you 6% on your loan. If the benchmark of 1% changes, they simply change that part of the equation and determine the total interest rate they charge you. If your loan is a fixed rate loan, the bank is obliged to keep your interest rate at 6%. But on the other hand, if the loan is a floating rate loan, you may pay more or less depending on which way that benchmark moves. There are several other important factors that might determine the interest rate a borrower might have to pay. In the example I just described, the bank has to pay its lender, i.e. the Federal Reserve Bank, interest on the money it borrowed, just like you would have to if you borrowed money from your bank. It will turn around and then lend that money at a higher rate in order to earn some profit. The higher the bank's cost of capital, the more it will charge its customers in interest. This concept is an extension of the idea that interest is compensation for using money that the lender would otherwise not have had access to. If the bank had kept the money rather than lending it out to you and its other customers, it might have invested that money in the stock market, for example, and earned a profit or return. If prevailing stock market conditions are such that it expects that it would have been able to make a high return, it'll likely charge its borrowers a higher interest rate to compensate for that. This is known as opportunity cost. As you can see, determining interest rates can become quite complicated very quickly, but without them, the modern economic world cannot exist. Interest rates both affect and are affected by the global and national economy and play an integral role in a country's economic health.